who are so for those of us that may have a traditional or conventional 9 to 5, one type of insurance that's commonly offered to employees is the group term policy. Now, the group term policy, it is what I call the free stuff, right? Why is it the free stuff? Because you, as the employee, don't have to pay for this policy. In fact, you don't have an insurance policy at all. So you could say that that's one of the cons to group term policies. All right. Your employer is the policy owner and the insurance holder, right? Those employees that are in the employee sponsored insurance policy, they receive what's called a certificate of participation or a certificate of insurance. And they have to be employed in order to get this type of coverage. Now, the coverage is honestly like good for a year, and it covers 1 year's worth of income or 50,000, whichever of the two is the lesser. All right. Now, that doesn't sound too great considering that, well, it's a low level of coverage. However, you didn't have to pay for it. So what do you really care? Right. Well, reasons why you should care is because in the event that you are unemployed, if you lose your job, if you quit, or if you're fired, or you get sick, or when you retire, the coverage in employee sponsored policies stops, and you'll normally have to convert your group term policy to a whole life policy, which can be extremely expensive, offer you a little bit more coverage for a whole lot more money, but really doesn't do you a whole lot of good. All right. Now, the pros to this type of insurance, well, again, you don't have to pay for it. Your employer pays for it. It's an expense to your employer. And, they get a tax write-off for it up to about $10,000. Right. So your employer is not necessarily concerned with your ability to, produce income for your family in the event that something happens to you. But it should definitely be something on your mind and how you cover your ass and your assets. So if the cost of group term policy, seems appealing because you might be the type that's saying free is for me, please reevaluate that thinking. The next type of insurance that we're going to talk about is called supplemental. All right. Now, this is what I call the cheaper stuff, right? But it's really not that cheap when we look at it on a grander scale. Okay. Now, supplemental insurance, it's a group policy. The employees get it as an option, right? Meaning for a little bit more money that they pay for out of their own pocket, they can increase their coverage from 3 to 5 times their annual income. So remember, the employer's group term policy offered them 50,000 or, the lower annual income. Well, supplemental is a little bit of a cherry on top, meaning like for whatever it is that your employer doesn't pay for, as far as your own insurance would go, you can add on insurance coverage for yourself and for your family members. But of course, you're going to have to pay a little bit of money out of the pocket in order to get this. Now, the pros, it is cheap, right? It's cheaper than buying a whole life policy on your own. The cons, though, is that, well, if you decide to quit, if they decide to fire you, or if you make it to retirement, or if you get sick, you can't take that insurance with you. And so what this also means is, one, with the conversion of your supplemental insurance to a whole life policy, in the event that the income that you were getting from your previous employment is no longer available to you and you're paying out of pocket for the whole life policy, that whole life policy you may not be able to afford. And in worst case scenarios, which is the best case scenario for the insurance policy, the insurance company, they don't have to pay because you're going to default on the payment of your insurance, which means you're not going to be able to get insurance anyplace else. And if you're sick, this just does so much damage to a family, right? So like, let's keep talking about, what is the most common form of insurance out there, right? And one of the reasons why whole life insurance is one of the most common forms of insurance out there is because, well, whole life insurance, let me show you what it does, right? Let's say that you're 28 years old and you're offered a whole life policy for $100,000, for the term of coverage, for the time of coverage, right? Which will, for a whole life policy, will last you from your age of 28 to the age of 100, right? Now that sounds pretty cool. Oh, I get $100,000 in coverage for the entirety of my life, right? Well, this type of insurance also comes with a savings component. And so basically, for what it is that you're paying into your insurance, by the time you reach age 65, which is the age that most of us may want to retire at, the savings component of this whole life policy has only amounted to about $80,000. Now, you may be asking the question, what happened to the other 20,000 when you're clearly paying a lot of money for a whole little bit of insurance, right? Well, what happens is in the first 2 to 5 years of that policy, the cash value component of it, of those savings, well, that goes to the commissions of the person, the agent who sold you that policy, or the company who the agent is representing, right? Now, the annual growth of the savings in the savings component of a whole life policy is only 1 to 4%. Now, this is no different really when you think about it in comparison to what you get from a high interest savings account with your traditional bank, right? And what happens to the savings once you reach the age of 65? Well, you can get the savings at the age of 65, right? But the savings is only 80,000. And if you were to die, well, your family would only get the $100,000 for the insurance, but the savings component, well, they don't get the savings component. The insurance company keeps the savings component. So is this really a good option? Some people may say yes, some people may say no. Some people are saying yes because the cost of $83 a month is also tax deferred. So they're looking at this as saying, oh, this just helps me reduce my taxable liability. Yeah, but that's really a whole lot of money you're spending to save a little bit of money on your taxes, when you could consider a term life policy where, let's say for the same example of being 28 years old, a term life policy would cost you significantly less, as you see, $28 per month, and term life policy can actually offer you a higher level of coverage. Now, term life does not come with an insurance component. However, in comparison to the whole life policy, if you were to take the difference from that whole life policy, right? So minus the $28 for the term, and the remaining difference would be $55. If you took that savings and you put it into, let's say, you were going to put it into another investment vehicle, number one, the first 2 years of the savings, right, the $55 difference, that equals $1,478, which is your money to do with it however way it is that you please. If you were to choose an investment vehicle like a mutual fund, which has an average growth of 9 to 12%, depending on which mutual fund you're looking at, essentially, at the age of 65, that $55 per month over the course of the amount of time until the person retired would equal, along with the average growth in that mutual fund, on average about $399,000, which is your money to do with it whatever you please, which in comparison to the whole life policy, where you only got that 80,000 in the savings component, here in the term life policy, you're able to see that you get a higher level of coverage with your savings. If you so choose to invest it, you can grow it and make your money work for you. And when you die, right, your family will not only get the $250,000 in term coverage, right, up until the time that the policy ends, right? But they'll also get the death benefit. So they get the 250,000 plus the 399,000, which equals a total of 649,000. So over $500,000 in comparison to less than $250,000 with your whole life policy. Now, there is another type of insurance that's offered out there that kind of combines the whole life policy, savings component with the term life duration periods, right? Now, what this type of policy does is ultimately offer you the same type of coverage that you would get with the term life policy. However, this type of policy is called a return of premium life policy. And for the cost of a term policy, a return of premium policy basically offers you the same level of coverage for twice the cost of your term life policy. Here's what else happens, right? Now, let's say that the term life policy was $22, and over the course of those 20 years that you're accumulating that additional $22, right? That would accumulate to well over $10,560. Now, if you were to place that into a mutual fund, right? Essentially, in year one, that $264, once you paid it up, it will yield you a total of $5302 as far as how much you paid into this policy. However, the balance at the end, if you look over here in the bottom right of the screen, right, where you look at ending amount from and market value in shares, your balance will be at $14,877, right? Now, the average annual growth of that savings component, right, that you would have gotten back in a return of premium policy at the end of the 20 years, instead of you getting back the $10,560, what you're getting back is $14,877. And it's all because you chose to invest instead of just trying to save and get your money back. Now, here's where you can also see this same type of comparison visually, right? Again, we take and we compare a 30-year-old young man who's not a smoker at the standard insurance rating, meaning that they're not too unhealthy and they're not the healthiest, but they're right there at the middle. So they get a good level on insurance policies, right? Now, if this person were to invest or, compare the cost of a 20-year level term with a 20-year return of premium versus a whole life policy, right? Remember, the term life policy costs only $22. But now the difference that you're able to save on the return of premium policy is $22. The difference that you're able to save on a whole life policy is $218. And if you took the savings the difference that you would have invested into a return of premium policy for 20 years, or the difference that you would have invested into a whole life policy, right? The total invested would be $5302 for 20 years into a return of premium policy, which would yield you $14,877 just by taking the difference from the return of premium policy and investing that difference into a mutual fund. In the same comparison, for the difference of $218 that would have gone into a whole life policy, if you invested that into a mutual fund, you would have invested $52,538, but your rate of return on that investment would have been $147,872. So, you definitely want to consider what it is that you need for income, because again, insurance is not to replace your life, right? Like most people, when they think about insurance, they think about the term insurances that are most commonly available and accessible. We're talking the term insurance for your car, the term insurance for your house, right? And those terms are usually set for time periods of 6 months to a year. Well, when it comes to insurance, term offers you a term of 5-year increments, 5 years, 10 years, 15 years, 20 years, 25, 35, even up to a 65-year term paid life policy, right? Now, each person is different. So each person's needs for insurance, or remember, insurance is to replace your income in the event that something were to happen to you. I want to paint a picture for you, all right? Where let's say that you had a husband who had 4,000, whose monthly income was $4,000. His wife, her monthly income is about 2,500 a month. Now, the husband's income for the year is only 48,000 and the wife's income is only 30,000. So they have a total of $78,000 that their income together would be either A, paying for mortgages, paying off any other debts, hopefully retiring for, saving for retirement, right? Because hey, they've got children, but they need to consider whether or not they need insurance up to the point of whether A, their children graduate high school, or B, their children are in college. Now, in the event that the children are going to go to college, right? Always remember this, and I've said this before in the financial wellness calls. Your children, they can work their way through college, but you cannot work your way through retirement. If you don't have a retirement fund or income that you're planning to live off of, remember that income is to help you not be a financial burden to the children that you produced that are now working their way through college, and they don't need mom and dad moving back in with them, which would totally reverse the situation, right? Now it's like, dad, mom, clean up after yourself, clean up your room, don't leave those dishes in the sink, right? But now none of us as parents want to be that type of financial burden or have to live with the rules of our children, because they're probably waiting to get us back for all the things that they felt we got them for, right? Now, if you're thinking about this and you're thinking about, well, you definitely want to have the type of income to replace income for either you or your wife if either of you were to pass, right? Because there is a financial detriment that is possible and can more than likely occur if one of you were out of the picture. So what I want you to really think about is the investment component, right? Insurance is not meant to be something that you use for the entirety of your life. It's only supposed to be in place until you've built up the income needed to replace the insurance and your 9-to-5 job income, right, for the rest of your life. That's what retirement is for. And when we're looking at pension plans and you're looking at, traditional 401ks, there are things that a lot of people are unaware of when it comes to those things. So over the next 3 weeks, we're going to talk more about 401ks. We're going to talk about retirement plans, right? But what I want you to do, what I want to let you listen to before I give you a financial needs analysis demonstration, to show you how I help people in my line of work determine their income needs, their insurance needs, and their retirement needs. I'd like to show you a little video from a gentleman by the name of Dave Ramsey. And maybe you've heard of him and maybe you haven't, but if this is your first time hearing him, he's got some great information. So let me let you listen to what he's got to say about whole life and term insurance.
And start spending money that you don't have even more. All right, checking in with the email bag, Tyler from Massachusetts writes, many people have a long-term need for life insurance. How can you recommend term to everyone? Don't you feel like you're giving them bad advice? Their term life insurance will likely expire when they need it most. Spoken like a great life insurance agent, Tyler. How long have you been selling life insurance? And those weren't questions, those were passive-aggressive statements, weren't they, sir? So let's deal with it, though. I can easily recommend term life insurance.
Whoa, what's going on, my guy?
The only thing, because the rest of it's garbage, it's a ripoff. You're much better off buying term insurance at about 5 cents on the dollar for the same amount of insurance, and investing the rest of your money. You'll end up with much more. Let's kind of follow this through for a second. You'll see what I'm talking about. Let's say I'm talking to a 32-year-old who has a 4-year-old and a 2-year-old. Let's visit him 20 years from now when his
I'm gonna
20-year
rewind that because I don't
point of
like the
selling life
pauses.
insurance. And those weren't questions. Those were passive aggressive statements, weren't they, sir? So let's deal with it, though. I can easily recommend term life insurance. That's the only thing, because the rest of it's garbage. It's a ripoff. You're much better off buying term insurance at about 5 cents on the dollar for the same amount of insurance, and investing the rest of your money. You'll end up with much more. Let's kind of follow this through for a second. You'll see what I'm talking about. Let's say I'm talking to a 32-year-old who has a 4-year-old and a 2-year-old. Let's visit him 20 years from now when his 20-year level term that I recommend expires. That would make him 52. He would have a 24-year-old and a 22-year-old. They should, hypothetically, both be out of college, both be grown, gone, out of the picture, no longer a liability. The kids are grown and gone at 52 for that 32-year-old 20 years from today. Let's see. His house would be paid for because you've never heard Dave Ramsey ever recommend a mortgage more than 15 years. So in 20 years, he will have been debt-free for 5 years, house and everything. Something to think about. Now, let's see. Would he have anything in his 401k? Well, if he's been investing what I teach, 15% of his income until he was debt-free, and after that, loading up on everything, if he made an average household income in America of $40,000, what would he have 20 years later? Well, he'd have somewhere between $500,000 and $700,000 in his mutual funds. Now, let's see. He's 52 years old. The kids are grown and gone. The house is paid for. There's $700,000 in mutual funds. He dies with no life insurance. See, his wife's got no kids, no mortgage, and $700,000. I think she could struggle through, Tyler. That's how I recommend term insurance, because I recommend doing a financial plan called getting out of debt and investing, along with the idea that your term insurance is going to expire. And then if you want to keep some term insurance and you're healthy, you may choose to do it. I have absolutely no financial need for term life insurance. A little bit for some estate planning things that we're doing, but very minor. The term life insurance I have is very simple. It's so cheap at 47 years old in the great condition that I'm in. And I don't smoke and I don't do all these crazy things like jump out of airplanes. So I can get term insurance for nothing. And it's so cheap, I keep several $1 million on me extra, just SWI. Sharon wants it. She'd rather have that than another thing on her finger, you know? All right, we'll be right back with more of your emails.
Now, ladies and gentlemen, I want to show you one more thing, because, you know, I don't want anyone thinking that I'm bashing the whole life insurance, right? But I do want to leave you with some juice, okay? Because there are a lot of people who, again, they either convert their group term policy to a whole life policy, not knowing what it is that they could do with the whole life policy, right? Now, there's something that I want to talk about in regards to a whole life policy, specifically about a universal policy, right? Universal life policy. And one of the things about the universal life policy, well, is that you have two types of it. So you have an option A and an option B. Now, most people don't know what option A is for a whole life policy, but it's the version that you don't want, okay? It is the default. Now, I'm going to tell you what option B is, so that way you can not even think about what option A is, but so you can go and correct your insurance if you got this type of policy. And option B for universal policies gives both the savings and the death benefit, in comparison to option A, which only gives you either the savings at 65 or the death benefit when you do die. So if you have whole life policy or a universal life policy, definitely consider going back, selecting option B, and moving on with your life, right? Because otherwise, I'm going to tell you, you're spending way too much on that whole life policy, where you could just be taking the difference and investing the difference into a mutual fund with average growth of 9 to 12% annually. Now, that's going to bring me to the conclusion of this. I saw that there were some questions in the chat, so I am going to address some of those questions, or at least the comments. One comment is spitting the facts, and I know you know. Keeping it rolling, brother. Sorry I've been absent, but my time has been so split with all, especially silver and gold. Love what you are offering community. Thank you, brother. Appreciate you doing that. And also he says term doesn't come with a savings component. You said insurance. I apologize if I misspoke and said term doesn't come with a savings, and it doesn't come with a savings component. Term does not come with a savings component. Return of premium comes with a savings component, but remember that the term of premium savings component is you paying double for the cost of your term insurance, right? And the amount that you were spending on your insurance, they basically give that to you at the end of your term without any kind of growth to it. So you didn't make your money work for you. You worked for your money and didn't necessarily do it the greatest of jobs doing that. All right. So not trying to tell you what to do, but I definitely want to show you how you can do it better. Now, I have one of my colleagues and partners on this call. And for what it is that he's heard, I hope he's heard some good stuff. But I'd like to just bring him into the call and also open up the floor for anyone that would like to ask any questions. Please feel free to do so, because we want to help you understand what insurance is, how to invest the difference instead of paying so much for expensive products that only